Welcome back, everyone, to episode 5 of Path to Profitability. Today we're looking at AMD, journaling, and equilibrium. You have no idea what that means, but I'm going to explain it, so don't worry. AMD. What is AMD? So, AMD stands for accumulation, manipulation, and then distribution. This is another one of the confluences that we use when we're placing a trade. So accumulation, what that means is prices staying within like a select range. So it looks something like this. If you can imagine, this is pretty much our range. This is accumulation. It's not picking one direction. It's not spiking up and then spiking down and then all over the place. It's just sort of confined to this certain area. If we take a look here, like this Asia session here, you can see it stays relatively, while it's in an uptrend, yeah, but during Asia session, there's no big moves up or down or, big candles really. It's sort of staying in the same type of area. So that's accumulation. Manipulation only happens after accumulation. And what that looks like is a move up or down that is essentially a liquidity sweep. It's a small liquidity sweep that takes out one side of it. So it could look something like this. So that's your manipulation right there. And after manipulation, similarly to liquidity, you're looking for a reversal. So this is your distribution. Like that. Let me show you an example. We had a perfect example of it right here. So Asia accumulated, as you can see, it stays within a decent range. London opens, spikes up a bit, takes out the high of Asia, doesn't quite take out the high of New York, so we're not targeting that. We see break of structure, inverse fair value gap. If you look, there's a fair value gap hidden in there. We see, let me zoom in. We see break of structure on this candle, and it's in a downtrend. What do we target? Next draw in liquidity. The Asia low. So stops above the high, Asia low. There you go. That's a trade right there. You could have carried it onto the previous day low. So overall, you're just looking for times where price is staying in a sort of similar range. So where it's not going up or down too much. And then when it does spike outside of that range, you're looking for a reversal in the other direction. Next, journaling. This is one of the biggest parts of trading. You might think once you've learned all the different confluences and you know your strategy and you know your edge and you've back tested it, you might think, yeah, cool, I know exactly what I'm doing. I'm going to start trading. I'm going to start making money. Does not work like that. Because while you place a trade, you don't see all the wrongdoings. You don't see, okay, maybe I could have done this slightly better on my trade. Or when you lose, you tend to blame other things like, oh yeah, market conditions are bad, or maybe this was just a bad trade, like I shouldn't have taken it. But why? That's what we do by journaling. So here, you can see, got my journal. This is just me back testing. This is me writing down my strategy, what I'm looking for, what an A+ setup looks like, and what that means is just my perfect setup. So what I would want to see ideally, and then take a trade. It doesn't have to be that every time, but my likelihood is if I see that, I'm taking that trade. If I don't see that, maybe I'll take it, but it's not guaranteed. A+ setup. We're looking for all of my confluences here. But journaling is so important, guys. If you are trading, all I can say is make sure you record your process. Make sure you write down your failures, your wins, compare them. What did you do right here? What did you do wrong here? It will make a big difference. And then just to finish it off for today, we're looking at equilibrium. This is another one of our confluences. All equilibrium is, this one's really, really simple. If you grab this little box tool here, it's on the side here. There you go. There's your little box tool. You should get something that looks a bit similar to this. Yours might be different because there's different settings, but this is how mine looks. Let me zoom back out there. Yeah, this is how mine looks with my settings. If you want to copy down these settings, pause the video, feel free. These are the best settings, hands down. So if you want to use those. Equilibrium. For this, you need to understand a premium and a discount. So think of it in a practical sense. If something's on discount, you want to buy it while it's cheap. If something's at a premium price, it's higher, you want to sell it while it's high, right? So same applies for stocks, shares, indexes, precious metals, anything. If it's within, let's say we had a move up like that, moving, dipping into 50%. What are people now wanting to do now that we're in a premium? The top half is a premium. People are wanting to sell. What does that mean? People start selling, the price goes down. So all we're looking for is a tap into 50%, and then it starts going down. But you might be asking, 50% of what? Now, it's 50% of a leg up or a leg down. So, for example, this huge leg down on New York session, we're going to draw from the high to the low. If we were to see candles draw into 50% of this, and then give us some confirmation that it's going to start reversing, maybe we could take a trade off that. Maybe we could start shorting. If not, if it doesn't draw into 50%, then we could continue the downtrend. Perfect example. Here we go. Boom. So as you can see, we've drawn from the low to the high of this move up. We get candles wick into 50%. This is now in a discount. People start buying while it's in a discount, and price moves up. So it's just, you see this leg up, this move up, we tap into 50% of it, boom, starts moving in the other direction. That's all equilibrium is. It's just 50% of a leg up or a leg down. If it touches it, we're looking to continue, right? So this leg up, did we touch it? No. So we wouldn't use equilibrium here. We could check for it, but it's not going to have as much impact. Now, what happens if you use equilibrium on a high like this, and we tap 50% and we just blast through? What does this tell us? Well, that moves us on to our next part of equilibrium, and that's a 78% extension. So if you have a look on the tool, you can see I have 3 little colored numbers here. So I've got 78.6, 0.786, 0.62, and 0.5. Now 0.5 and 0.62, if price stays between this range, you can assume it's going to rebound. If price goes up into 0.62 above it and starts to go towards 0.78, it's unlikely it's going to start moving back down. Like it's momentum in that direction. And if we reach 0.786 and we close above it, all that means this has been denied. Similar to an inverse fair value gap, how you see a fair value gap and a candle closure below this shows it's invalid. Same goes for 78% extension. So if we saw, let's say we saw a candle come up and close here, cool, we could consider a reversal. But if it comes up and closes above the 78% of this move down, for example, we got something like this, and we go into this candle and it closes above 78%, that tells us we're not looking to take this trade, it's looking to go in the other direction. So your homework for today, make sure you're looking at AMD, accumulation, manipulation, distribution, write it down, understand it, which one each means. What does accumulation do? What happens when manipulation happens? What are you looking for when a low or a high gets manipulated? Are you looking for more accumulation? Are you looking for distribution? How do you know distribution? Use your other confluences that you've learned, pair it together, have a look at the chart, do your homework. Journaling. Obviously, if you're not trading yet, that's why I would suggest start paper trading, which use your fake money. Journal. Even if you're not using real money, it's important. It's going to help you grow. And equilibrium. Just mark out some leg ups, some leg downs. For example, this one here. Draw from the high to the low. See where 50% is. Know where you're looking for it to tap. If it goes above 78%, we're not looking to take it. That's all you need to know. Mark out 3 of those. So 1 in a bearish example, so like this one where it's going down, and 3 in a bullish example where, for example, this leg up here where it's moving up. Mark out 3 of each. And yeah, guys, that's it for today. Make sure you're doing your homework. Keep following the series, because I know a lot of people have dropped off. You know who you are. If you're here right now, I'm proud of you. Keep it pushing. Keep those same consistencies up. Keep watching the videos. Keep back testing. Keep, following the lessons. Doing your homework is important. If you want to grow, you want to start to make money, because that's what we all want at the end of the day. Just do your homework. Watch the videos. That's all I can say. So yeah, nice short video for you today, guys. Have a good one.